Good afternoon, good evening, and a very good morning to everyone. My name is Ralston Fernandez, and I lead the financial services practice for network science. For all those who have joined right now, let me give you a quick recap of what happened in the last 1 hour. We had an amazing session that was run by Reese Spencer, who runs the ICAP Data and Analytics for Asia Pacific, with an amazing list of panelists from across the industry, which specialize on treasury markets. For the current session, we would like to focus primarily on the corporate treasury, the treasury management in today's VUCA world. So just to give you a background to how treasuries have evolved over a period of time, I would like to take you back to the 1990s, to the era of 2008. The 20 years or the close to 20 years that went by were primarily focused on a traditional cost center approach for a lot of treasuries. And the way treasuries were functioning were, as soon as risk arise, it needs to be hedged, a pure cost center approach. And then when some of these entities, which were subsidiaries of a parent company with folded hands, had to follow instructions of their godfather, which ended up being the group treasurer, uh, and just follow a particular process of managing risk. Now, some people qualify that as value-added services, but we all know how it happened. And then came a time close to 2008 during the subprime crisis when things started to change. Uh, a lot of us have gone through the subprime crisis and seen how the world changed post that. One important aspect post that subprime crisis was a quick shift of some of the high performing traders and bankers towards the corporate treasury and the hedge fund market. What did this do? This changed the way some of the corporate treasuries focused on their business. The approaches changed from a cost center to a quasi profit center. Now you had that talent, which earlier probably you were never in the position to hire. You had that talent who could take some amount of risk and probably give you a little higher yield on the overall business. Post 2008 and especially post 2011, we saw a lot of these regulatory reforms that came into picture. Dodd-Frank Act, EMIR, MIFID, the Basel III, all of these different regulations made business much more complex. The risks increased for businesses, especially bankers saw this probably a good way of ensuring a lot more transparency when they did business with corporate treasuries. And for corporate treasuries, it was a wonderful occasion where they could sense, they could transform into a profit center approach. What changed for them primarily was they moved from an operational plus transactional roles to a much more strategic roles. Strategic, wonderful for a corporate treasurer, isn't it? There was an increased ownership, a sense of responsibility that came from the corporate treasuries, and it also introduced a lot more sophisticated systems along with the regulations and the risk which came into the markets, and it made the work of a corporate treasurer much more complex. To handle all these complexities, we also saw how technology reinvented the wheel. And as we step into the pandemic era, which is the new age era, we see how Deeptech is helping such corporate treasuries guide to the next wave of a future and a realistic business. So we now move to our poll. We would be running a quick poll on uh, on the treasury business. In the new age world, what would be your preferred technology partner for a treasury solution? Would it be a SaaS-based treasury platform that provides a high level of flexibility? Would it be B, an enterprise treasury solution, or would it be probably, if you have been running your treasury on a spreadsheet or something else, would that be the way you see how your business would work? What we have witnessed is that there is a 100% poll that has come for a SaaS-based treasury platform that provides a high level of flexibility and customizations to suit your business needs. With that information, let me quickly introduce you to our next session. Our next session focuses on how treasury management has changed into the VUCA world. For this, I would like to introduce you to Arshdeep Jindal, who runs FinVisage as its founder and CEO. Arshdeep comes with an impeccable pedigree. He has been an IIT and IIM Bangalore graduate, has spent many years in London trading oil options, was an integral part of the Uncharted trading desk, and with his all experiences of not being able to do much more justice towards the way technology is seen on the trading floor, he stepped out to make a difference. And that's where the genesis of Envisage was born. Arshdeep is ably supported by Jayant Ravindran, his co-founder. Jayant is also an IIM Bangalore grad and has come with amazing experience behind him on the technology front. At FinVisage, he leads the technology and delivery. His earlier experiences were at Mu Sigma, where he led large teams on key client deliveries. With that introduction, I would like Arshdeep and Jayant to quickly take over, and it's all yours.
Thank you, Ralston. I think I'm audible. If there's any problem in the audio, please, Ralston, give us a shout. So it's very nice to be with everyone here. My name's Arshdeep, and I've got Jayant with me, and we're from FinVisage, as Ralston mentioned. So let me just start straight away with what we are going to speak about with you today. We're going to speak about how fintech is supporting treasuries and finance at banks and corporates in a world that is more VUCA, right? And what does VUCA stand for? Where does VUCA come from? So the V in VUCA stands for volatility. Over the last 5 years, volatility in FX and rate assets has been trending upwards. There is a well-known HSBC corporate report out there, which basically says that 57% of all corporate treasurers admitted that they had experienced lower earnings in the last 2 years due to significant unhedged FX exposures. Now, it is easy to say that this could have been avoided if they had gone for hedging. However, the answer is much more nuanced than that. This is actually due to the increased volatility that is being seen in these underlying assets. And the uncertain environment that also creates is compounded by changes in the market structure. So a key example for that is the phasing out of LIBOR and replacing it with various RFRs, such as for USD, there is SOFR, for sterling, there is SONIA, and so on. Another very popular report, McKinsey, mentions that 75% of banking models still involve LIBOR, and they have yet to be redeveloped. So you can see if you look at these sort of statistics, it tells you that the world and the circumstances and markets are moving faster than individuals and corporates can respond to them. Complexity and ambiguity is introduced because of a trend that is driven by the finance treasurers themselves. It is that treasury is becoming more and more of a strategic function, as Ralston mentioned in his introduction as well, versus the situation that was in the 90s. Corporate treasuries have evolved, and they want to become partners in the growth of the company as well. Now, that is the increased complexity that is introduced in the working of treasury departments. Now, to address that complexity, advanced tools are the answer, rather than having to create those tools from scratch in spreadsheets, which is usually the approach that is taken today. transformation of this finance department from a cost center to a strategic line of business. And in this transformation, if there is an absence of data at your fingertips, then decisions can become more ambiguous and it can lead to results which might not be what you had planned for or expected. If we move to the next slide, now gaining control, this is where a one size fits all approach no longer works. This idea of having large overarching technology systems and then going and selling the same system to every corporate out there or every bank out there is not an approach that works now. Different treasuries in every sector need a driver of control which works for them. Now, the main drivers which cover the universe of these requirements, they are summed up there on the screen for you. Let's take the first one, and I will hand it to Jayant here to take us all through this.
Talking about riding the shift to cloud and SaaS, it's not a matter of if, but when. In the last 4 to 5 years, we have seen a major shift in adoption of cloud-based applications and deployments among finance and IT teams. Going forward, cost and security implications will force all companies to eventually adopt the cloud. And why not? The cloud model provides several attractive benefits over the on-premise offering. Traditionally, treasury and finance systems have been known for being clunky, not oriented towards a great user experience, but focused on delivering functionality. Most implementations were on-prem and had issues when it came to support, upgrades, training, and total cost of ownership was high. Today, there is a greater emphasis on user experience, and a lot of time is spent thinking about the customer when it comes to user interface flows. Cloud offers the benefit of being able to support remotely, easy access to application upgrades, bug fixes, and fewer concerns on scalability as your business needs and data grow. Weeks have been shaved off the implementation timelines. Most importantly for SaaS, this has helped drive down the CapEx and OpEx, which has helped bring in innovative pricing models that are more appetizing for corporates. Cloud is very secure today. The AWS and Azure platforms of the world hire the best security experts and have all the necessary certifications to ensure the platforms are secure. Further, SaaS providers are able to set up the right configurations and safeguards when it comes to hosting and security. The data residing within the cloud in databases and data in transit are secured with 256-bit military-grade encryption. The data centers are structured in such a way spread across the world that if you have concerns on data governance, they can be kept in data centers in your location of choice. Network and host intrusion detection systems, CIS level 2 hardening of operating systems reduce the attack surface and vulnerabilities. Security groups, public and private subnets control incoming and outgoing traffic. Regular penetration tests and adoption of OWASP standards ensure the software as well is quite secure. In effect, comfortable pricing models and greater access means that more licenses can be shared across the team and across the key shareholders. What does this mean for the treasury team? It widens the visibility of what they do and the ability to deliver reports to those who need it in the most appropriate manner. Ashdeep, for the next point.
So now let's talk about empowering the teams at banks and corporates with advanced tools and technologies. Market risks at corporate treasuries are managed through hedging transactions, and there are banks who support them in these hedging transactions. The starting point of the Treasury Department is identifying the sources of the exposure, the quantum, and the expiration dates. It's a highly complex process which requires a lot of coordination amongst teams which are scattered. Once these are visible, though, the next process is identification of the hedging gaps. Currency moves will lead to a direct impact on bottom line if these hedging gaps are not addressed. So once identified, the hedge strategy needs to be built. This means deciding on the derivative structure to be used and amount of funds that will be spent. Now coming to the bank side, who support their clients in their hedging activities. Bank salespeople are at the front line dealing with corporates multiple times a day. They are providing quotes and structuring deals which fit into the budgets of the corporates and fit in with their hedge strategies. So let me take you through how we have made advanced derivative structuring tools available to these sales teams. It is a tough task, to be honest, if you ask them to coordinate indicative quotes from very, very busy trading teams and then simultaneously facilitate the structuring requests from clients. And technology is a way to help that. JR, are you sharing the screen right now, or is it someone else sharing the screen?
I'm sharing the screen.
Right. So let's look at one example where we're talking about the most common structure out there, which is a zero cost collar. And this is a Indian client. In our example, that we're talking about an Indian client who is an importer. He's looking to buy dollars or buy the negate the risk on an increasing dollar price, and therefore looking to buy a dollar call. And to make it a zero cost structure, he will be selling a dollar put as well. He's fixed the call strike at 78. He's given the maturity date as 15th of September. His notional is $5 million. Those are the contours of the structure that he's looking for, and he's looking to see what is the put strike that he has to sell. Now, the bank salesperson knows that his CVA and margin is 25 basis points, which is equivalent to 9 lakhs and 12,500 rupees. Now, what the salesperson now has to do is structure this derivative for the client and come to a put strike which he can give to the client. So what you see on the screen is, Jer, you might want to just zoom in a bit, like increase the zoom a bit, if you can.
Better?
Yeah, that's better. Yeah. So the salesperson goes and selects $INR in the underlying. There were a series of other underlyings that he could have selected. That depends on what is being used by the bank. The market data is automatically loaded into the system by virtue of selection of the underlying. The corresponding market data gets picked up. The next step is then to move into the structuring screen, where the salesperson starts putting in the contours of the price. The spot rate, if it has moved, he can quickly update that. Let's say it had moved to 73.5. The maturity date was 15th of September. So he inputs that into the system. The system has automatically calculated and built out the forward rate from the market data that it was holding. The strike that the client gave to the salesperson was 78. So that is where he needs to, that is the call strike that he wants on the structure. And the notional was 5 million. And on this, we want to seek for a zero cost collar by changing strike 2 for a CVA margin of 912,500 rupees. Right. So now if we click on seek strike, what that does is the system very quickly runs the calculations and then returns a number which is 74.31 as the required put strike that needs to be given to the client to satisfy all the conditions and satisfy the bank's requirements on the CVA and the margin. So having this tool at your fingertips gives the salesperson that increased flexibility and the ability to answer questions very quickly for the client. The client might say, can you change it a bit? What if I made it 78.5? What if I change the strike a bit? And so on and so forth. So all of that is very easily done. If the salesperson wants to quickly draw up a payoff graph, that is also very quickly done by the system by just clicking on price, and the payoff graph will show up there for reference. Now, the client might want a modification in the structure. So he says, instead of doing it in one shot, I would like to do a strip of options. So where the modification is that he's doing a strip of options of 1 million notional each over spread over 5 months. Now, in FinVisage, you can do that using combinations where the salesperson can go create a combination in the first instance, but that can be saved for future usage as well. So in this case, he wants to create a combination where there is a strip of collars that he is doing over 5 months. So he says, okay, I'm choosing FX collar, goes into save and price again. And in this, Now the conditions that have been given are, I want to do it for the months of July to November, say, and the maturity dates need to be the third Wednesday of every month. Let's say that's the conditions that have been given. So again, same method, 73.5 probably is the spot rate. Let's change it. If it needs to be changed, spot rate is changing every second. Number of legs is 5. And then to create the dates, there's a scheduler that you can use where you go into monthly, say that you want to use the third Wednesday of every month. Therefore, the system, and it has to start from July. So you go and select it from July. And what that means is that the system automatically creates those 5 legs with the 5 dates there correspondingly to those third Wednesdays of every month. And then this can continue. You can start putting in the details as you would have done usually, and then click done the calculations accordingly. Now, these are structures that almost all markets are very familiar with, and they're very commonly used. Now, there's a recent introduction in the market. So, Jerry, if you go back to our slide, there's a recent introduction in the Indian market of what are called exotic structures. The underlying characteristic of these exotic structures is that the payoff is dependent on the path that the underlying takes. Unlike in previous structures where the payoff is known in the beginning, if you just know where the underlying will end up. But in an exotic structure, the path that the underlying takes to get there is also super important. So a very common exotic structure which is used in the Western markets, and I think will also be ported into India as well, is a modification of a forward called a target accrual redemption forward. Now, in this, if we create the example again, we're looking at a strip of 5 forwards, which have the 4 maturity dates of 3rd of Wednesday of July to November. The notional on each forward is $1 million. So therefore, the total notional of the structure is $5 million. The client is an importer and therefore is looking to buy dollars. However, what they want to achieve is a forward rate, which is 2.5 rupees better than the prevailing forward rate. So what they're looking for is that if they were to do the forward today, they would have achieved a certain rate, but they want to sort of improve that by 2.5 rupees. And to achieve this, the client is willing to cap the total amount that they receive in positive settlements at 5 million rupees. So once that total amount is achieved in positive settlements, the structure knocks out immediately and the client is left unhedged for the rest of the duration. And in all other aspects, it behaves like a strip of forwards. So the client is getting a better rate at a cost of capping what the total positive settlements can be in their favor. In this case, let's say the salesperson has a CV of 30 basis points, which is equivalent to 1.095 million rupees. And now in this case, can this be achieved? The question now for the salesperson is, okay, I've got these conditions from the client. Can this be achieved? Right? So here again, the way to price something like this needs to be very quick and intuitive so that the person can quickly input the information and get there as quickly as possible. So in this case, let's say, so again, we go back and we start changing the price. We will continue to change the spot price just to show you how easy it is. But now in this case, the knockout currency is given by the client in rupees. So we can choose 5 million rupees there. The knockout currency could very well have been in dollars as well. The number of legs was 5. And again, the schedule was the 3rd Wednesday of every month starting from July. So we go into the 3rd Wednesday and we put a starting date of July. And that the system will then go and create the schedule of dates automatically on that basis. The notional for every month was 1 million. And the strike is 2.5 rupees. Now, the forward rate for that is, let's say 75. This client knows that. So let's say he selects as 73 is what he sees as a 2.5 rupee improvement on the forward, prevailing forward. So when he clicks on price here, what the system has done in the back end is use mathematical models to price this path-dependent structure, exotic structure, and come up with a right modeling there. So Jay, can you just zoom in a bit? I'm not able to Okay, yeah. So that's 690 million. So what the system is saying that no, it doesn't work. You cannot buy it for 73 rupees forward, because that would mean that you have to pay a certain premium. The client has to pay a certain premium to the bank. And usually TAF structures are zero cost structures, and therefore the answer that the salesperson needs to go back with, okay, if 73 doesn't work, what works, right? So let's say 74. Let's just put 74 there and see where we get to. So this should be as easy as this, right? So you should be able to change the 74 very quickly, click on price again, and the system goes and prices it again and says, okay, you're now receiving too much. So that means that this has 2 million rupees margin in the trade. So that's a bit too much. We only need 1 million rupees of margin. So then 73.7 might be the correct answer there. So basically, what we're looking to do is put in keep changing the strike a bit, try to get to the right answer. So we're almost there. So 73.65 might be the answer. So that is what the salesperson can go back to the client and say. So the forward is 75.46. We can give you 73.65 as the TAF price. So you are getting a $1, 1 rupee 80 paisa improvement on the forward rate, and your net positive sum of your positive settlements will be capped at 5 million rupees. So a tool like FinVisage gives the banker an easy interface to price any structure. It can be used on the go on their laptops or tablet, which is one of the things that we saw is very important. This future is going to be this not systems that tie you into the office, but which can be used on your laptops and your tablets, and easily accessible via the browser. And all of the complicated calculations of parity, Black-Scholes, Monte Carlo, and so on, they carried out under the hood, and the user need not worry about these complexities. So to take you through the second control, let me move it back to Jayant.
So to take decisions across a wide range of tactical, operational, and strategic problems, it is important that the right information and analysis is available to the stakeholders. For instance, treasurers wish to hedge as per the board mandated policy, but the entire set of exposure flows are not available or is dated, or maybe they only have major planned exposures. This means that a number of times the corporate treasurer may not be able to use the benefits of netting. They may be over or under hedged. Let's take another example. As a treasurer, visibility of cash flows is key for planning business action. But cash flow information resides across the organization in ERP, accounting software, loan management systems, a number of spreadsheets spread across business, teams, or entities. Aggregating and capturing this information at your fingertips is a necessity to ensure sufficient time to plan for funding needs or to plan on how to deploy excess funds. This data diffusion is a key challenge that impedes decision making. So how does one go about fixing this issue? We follow a certain decision template when we work with our clients. So step one would be identifying the end goal for your organization. This will require an exploration exercise where we understand the reporting and analytical needs of your organization. Together with key stakeholders, we architect the end state of where you need to be. This may be driven by various goals, such as preparation for the organizational goals, such as maybe preparing for an IPO. There may be an major investment coming up, mergers, or specific growth plans. It will involve speaking to various key stakeholders, undertaking secondary research, talking to experts, etc., to finalize what is required to deliver that end state. It will also require a study of your existing systems, what data is already available, and what more needs to be added. Again, the window of analysis for this end state may be a short-term or a medium-term one dictated by your organizational needs. Following that, we work with your IT teams and technology experts to identify the best solution to deliver your needs. For that, you will have to look at current solutions already being used within the organization. The final solution may vary or be spread from all the way from having a focused solution to deliver a specific requirement to the other end, where you may actually end up setting a data warehouse for more complex reporting needs. And all of it is driven by the complexity of your reporting needs and the availability of budget. Let us take you through a system of ours that helps corporations meet their ALM and other reporting needs. This would be an example of the first case where you have a focused solution. So this is again a cloud-based solution, where as you can see in this page, the system has the ability to add and integrate from various data sources. So the data from various inputs, maybe ERP, accounting, software, or maybe from different business teams, or even from entities, can be aggregated into one place. Then we have our own mapping engine, which takes these data cash flows and helps you to convert it into the cash flow sheet as you see it in your organization today, a highly adaptable system and a process that helps you set up your cash flows as you see it today, and maybe managing in Excel sheets or other ways today. So once you have all of this information, the system is then able to generate the various cash flows. So as you can see here in this example, what you see here is a group level cash flow, where all the cash flows across entities have been brought together, and you're able to visualize your overall opening balances and closing balances. The opening balances are set up by taking inputs from your various bank accounts, aggregating it, and you are able to start with a certain opening balance, and then you're able to visualize what are, based on all the information that has come in, what is going to be your closing balance maybe for over the next few months. And you're also able to see a breakdown in terms of key cash flow line items across your major heads, such as financing, operating, and investing, all the way up to your closing balances. You can even drill down into specific numbers to see what go within it. Now you have this information, right? And what are some of the things you would like to do with that information? It's a good information to have, but then maybe you want to pivot this data. You want to see a different cut of the same information. Now that is also readily available, as you can see here. I've taken the same information and basically pivoted it to produce an entity business unit view. So here, that same information, instead of that cash flow line items, you're able to see your various entities and the businesses within those entities, where you can see the net cash flow impact at a business unit level. So same data has been remodeled. Now, let us assume that as a treasurer, you're working with your senior management, you want to help them drive certain business decisions. Let us say there is a certain acquisition which is coming up a few months hence, and you want to visualize what will happen once that acquisition happens. So you can model that acquisition over here. As you can see, you can set it up. You can mention that this acquisition is happening in the hospitality limited business in maybe in the month of December. And then you can run this scenario. And then you can see that when you overlay it over the existing cash flows, the cash flow profile has completely changed. You can see a dip in the last month now. And you can also do a comparison of this versus your previous original baseline forecast, as you can see here, and see at what points has the cash flow actually deviated. Now, in this case, I've taken one scenario. You may similarly be able to overlay several such scenarios and visualize the overall impact. And once you're happy, you can share the same with key stakeholders so that they are also aware of what impact of certain business decisions could be. Now, to talk about so we talked about the first case is focused solution. Now, let us talk about a case where you may want to manage more complex needs, where you were looking at a data warehouse, and Arshdeep will take you through a real life use case that we have worked on.
So we're working on a real life case where the client is a trader. They're a commodities and an FX trader, and they have a requirement to take their finance team and their support functions on middle office and back office and make them ready and fit for any corporate event. So that corporate event in the future could be an IPO, it could be a merger and acquisition, and so on. They're doing phenomenally well in terms of P&L, and they are looking now to get the support finance function and the back office and middle office function ready. So what we have done for them is first of all, the vision is to set up a comprehensive package of key reports and look at also any ad hoc reporting capabilities that might come up from stakeholders. And the stakeholders here are the current investors, but more importantly, the investors that they are going to target in the future when investor roadshows start, then management, board, and then the internal teams. So a sample of the reports that will be looked at are P&L, market share, key ratios analysis, capital usage, liquidity risks and forecasts, counterparty credit risk, VAR analysis, opportunity cost of idle cash, investments, and many other reports. So this is a sample of the reports that they are going to get from the data warehouse. How are we going to apply this? Like I mentioned, we're going to go for a data warehouse approach where the data modeling, again, data warehouse it seems like a catch-all term. It shouldn't be. It actually depends on the data model, and that data model depends on the current needs, reporting needs, and any future reporting needs that can be defined today for the finance and treasury. So if once those are done, the right data model can be created, and then the data warehouse is in place, which then supports the entire reporting framework. The key success factors that we have noticed, one is the availability of budget. Second is that there is a buy-in from top management for the absolute necessity of a system like this. And the third is the collaborative approach between the client and us, where when we need to, we can, whenever we need someone from the client side, we have access to them. It is part of their day to day. It has been made part of their job description to support in terms of the knowledge that they have that we need to build out the system. They need to support us, and then we are very, very responsive when there is any requirement from the client side. And if there are day-to-day changes, if there are scope changes, we are very responsive on that front as well. The underlying ethos behind it is automation, automating the process of creating these key reports and getting them ready as quickly as possible.
So as treasury responsibilities scale, right? I mean, people do not necessarily scale along with it. And that poses a challenge, right? I mean, how do you respond on time? Because most of the time, the key report, at least for your senior management, was to be ready as of yesterday. The board needed it as of last week. And you already talked about the fact that information today, a number of cases we have seen resides in disparate systems, and you're constantly trying to put everything together. So while this is, I would not call it a separate element that exists separately. This is probably it layers over all the other points that we mentioned. Is the point on automation, and automation is important because that improves your productivity several fold. And in a way, it is a product of proper identification of requirements and technology selection. It would mean you have to identify the priority reports and alerts needed for that you need to be on top of for key decisions and actions. Identify the key stakeholders and the best approach to deliver the report information and or alert. And once that the business approach is clear, you need to then identify what is the right technology to deliver the same. So that sort of template sort of works over here as well when you need to plan your automation. Just to talk about our product offerings, just ask Ashdeep to take this over.
Absolutely. So this is just the final slide, after which I will hand it back to Ralston. So just a quick run through of how we've structured our offerings. We have an advanced pricing engine for banks, and this is to enable the treasury sales teams with an on-the-go derivative pricer to close deals as quickly as possible, respond to client requests as quickly as possible. The second is a corporate hedge management platform, which again enables the corporate treasury teams to manage the portfolio of hedges that they do and manage the quotes that they get from counterparties, and all of it is driven by what they get in reports at the end. The treasury management for non-banking finance companies is our third product that empowers the treasuries at these important companies with the twin solution of targeting the borrowing and the liquidity risk. So both of those are super critical aspects, and I think we heard about this in the previous panel discussion as well, for non-bank finance companies, and the third system caters to that requirement. The fourth is getting a finance and treasury in department fit for any corporate event. It could be an IPO, it could be capital investments, it could be just getting ready for due diligence because there's a huge investment going to come in. And we have a blueprint and we have the technology to back it, which expedites getting the finance team ready for that. Roshan, I'll hand it back to you now, and I'll leave it to you to guide it.
Thank you, AJ. Thank you, Jayant, for that insightful session. I will quickly open up the Q&A. I can see questions coming in thick and fast. So let me just bounce this question to you, Arshdeep. Uh, we had a panel discussion prior to this session where there was a discussion about around data privacy. How do you see your system handling such a situation?
So we did speak about this in our session, data privacy. JR, do you want to just quickly touch upon that again?
Sure. So when it comes to data privacy, there are, it is very important to look at what is the data you're trying to protect, right? I mean, data can be classified in various ways. You have transactional data, you have personal data. So it's very important to classify your data and then plan what are the approaches you need to take to protect that data. Like for example, one of the cases approaches would be, your data that you keep in your databases, etc., is encrypted. It is secure, so external intervention, etc., is not possible. Above all of that, because of the way deployments happen today, right? I mean, it is not a manual deployment where somebody sets up the database, etc. The entire process is completely automated. So manual intervention can be limited to a large extent. So, and certain levels of process controls can also be put in place to ensure that your data is well protected. And then you can also follow. We also follow some best practices when it comes to GDPR, etc. So personal information is not recorded or stored. So all of that help you manage data effectively.
Encryption is also a very key input that we used, JR. You had mentioned earlier about encryption being used for data at rest, data in transit. And then there were certain hardware actions that we take as well at an application level, which is in addition to what the cloud providers offer,
Right.
give us as tools.
Right. So all in all, the client then, it basically gives the client the confidence that their data is only something that they're able to view from the front end, rather than something, and it can be well managed in a secure way.
Okay, let me quickly bring the next question to the forefront. Big legacy firms already have well recognized ERP systems in place and paying hefty amounts. Do you think that the platform like yours can offer something unique which can attract such big firms?
So the answer is yes, and I think the keyword there is legacy. And I mean, technology has moved significantly since the last 10 years, since what it was 10 years ago. And what large companies are looking at us for solutions is solutions in very specific and targeted areas. So an ERP solution is not a derivative management solution, an ERP solution, or it is not specialized for that sort of area. And trying to be like we spoke about earlier, one size fit all approach means that you end up with suboptimal solutions in certain areas. So companies are looking at us for is I have a specific problem which requires a domain expertise solution, and can you provide that solution for me, which would solve that specific problem within the context of what I have already, which is what we in terms of technology we focus very heavily on that it shouldn't be an additional technology, additional system that somehow needs to be managed. It integrates into your current ecosystem, but it goes and solves the specific problem. To give you an example, so there was a specific problem can be, I am dealing with multiple counterparties, and therefore I need a way to manage all of the quotes that I'm getting from these counterparties, because there is an audit requirement for me to show. And not just that, I also, for my own record, want to see where is the quality of quotes going, which counterparties are doing better, which counterparties are steadily moving up the chain or steadily getting worse, who are winning deals, who are coming second consistently, and so on. And that will mean that if I can give that feedback back to the counterparty who is consistently coming second, he might start to win more business with me as well. Today, once that quote is done on a phone or somewhere else, that information is completely lost. So our solution specifically solved that problem, where all of the quotes were could collate it together, and everything, all of the data analysis could be done on that as well, with absolutely no additional work from the client side. They actually saved work in that, and everything was recorded. So, and that fits in very nicely with whatever other they have there. This is not available in any other system as well. So yes, so the answer is yes, we do have solutions, and they are unique solutions which cater to specific problems that big firms have.
Very good. Let me pick up another question. Which are the systems that your platform can integrate with?
Jaya, do you want to pick that up?
Sure. So we have integrated our system with LMS, loan management systems, ERPs, and accounting softwares as well for various clients. And integration in a way is always a very customized offering, because you're trying to solve a very specific business problem. So I mean, that is something we have always been very successful at, and it's not a problem at all for us when it comes to integrations.
Do you want to talk about the APIs that we have? And
Sure. So I mean, typically we integrate using REST APIs, which is almost like a universal standard today. And as long as you got a REST API, a system can definitely integrate with it. And there are also other solutions in case, sometimes we do face situations where your software does not allow, it may not have an API. There are certain rare cases because you may have a legacy software. In those cases, we do support by a process called loose coupling, where you can do a scheduled pickup of a certain report or a file output from that system. So there are various mechanisms that we adopt for integration.
Okay. I have this question that's come up on my WhatsApp. I'm not sure whether I can take up this question, but let me enjoy the perks of being a moderator. So the question says that, do you think new age derivative prices will bring in increased transparency and help in reducing spreads? Now, this is a classic banker corporate treasury problem. You know what I mean. So I open up the question to you, AJ, to answer.
I think the way in which, if you look at it, I don't think we should look at this as an adversarial sort of approach between a banker and a corporate, where the banker is consistently trying to increase spreads and the corporate is trying consistently to catch the banker out and trying to reduce spreads. I don't think that's the right way to do it, and I don't think bankers look at it like that. I'll be honest with you. I come from a banking background. I think bankers want long-term relationships with their clients, and if you talk to experienced bankers, they drive that. They absolutely instill that in their teams as well. That we are not looking to do a one-time large deal and then forget about the client. This has to be consistent business that comes in regularly, and for that we have to provide them with a fair price, which reflects the credit risk that we are taking on the client and the margin. And also we have to give them good service. So I don't think advanced derivative prices like ours are coming in to add friction. I think what they're coming in to do is fill a gap which is there. And the gap is there from a banking point of view. The gap is there. Why doesn't every salesperson have? It's like saying to every salesperson, you can't use your own email, right? You have to use a shared email. It doesn't make sense, right? If his bread and butter is to go and sell treasury products, FX products, rates products, and he doesn't have his own independent pricer to quote the 99 times that he has to quote out of 100, which are indicative quotes, and he only has to come back for a live price once, then you are not giving him the tool to do his job. So, and in the same way, from a corporate side, where the derivative prices are being used, they are being used as embedded platforms to price their portfolios. So they have a series of hedges on. They have bigger questions, worries than just looking at saving a few cents on the deal. They are looking at, can I value this portfolio correctly? Can I run a scenario on it correctly? What happens tomorrow if dollar INR were to go to 80? What happens to the mark to market of my portfolio? Will I face any additional credit calls from the bank? Can I model my bank's limits into it and see if I will be safe? So those are the questions that the corporate treasurer is looking to ask. This is the this is the typical thing of saying, I want to be prepared. I don't want to have a shock, and therefore I want to keep my management prepared as well. Right. So I think the underlying derivative pricer that is coming in to fill these gaps. It is not, looking at that. It is less of that margin discussion, in my opinion.
Right. So I think looking at the paucity of time, any other questions? Probably, we would be happy to get this email to you, AJ and Jayant, so that you could answer them in your free time. Uh, so I think we are good to end this session. And thank you so very much, AJ and Jayant, for your time and giving us insights on how new age treasury systems can be game changers in today's VUCA world. Thank you very much.
Thank you, Ralston. Thank you for giving us that.
So we would be running now a poll primarily aimed towards how the session went by. So if you could just pull up the poll. So guys, what are you waiting for? Just answer the poll, and we have a session coming up next, which is going to talk about how AI is shaping the future of debt collection. Don't go anywhere. We would be right back after a short break. See you.